time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. All right, I might as well start on Algoma Steel Group. This is following up a question. It was a two-part. There was a question that involved Algoma as well. We've talked about it in the past. Symbol ASTL on the TSX. Trades around $9.61, $995 million market cap. They are based in Sault Ste. Marie. Algoma is one of Canada's leading steel producers. The company has a production capacity of 2.8 million tons, with products that include hot rolled coil, cold rolled coil, and plate steel. I love anything with coils in it, so I'm loving that. So this past Wednesday, Algoma reported its Q4 fiscal year 2023 results that came in slightly above street estimates, but well below fiscal year 2022 numbers across the board. The company released its Q1 fiscal year 2024 guidance that was well below the previous year. Additionally, Algoma provided updated budgetary estimates for its electric arc furnace, or EAF, project that include significant cost and time overruns. The announcement was a surprise, as in late January of this year, Algoma reported the project was both on time and on budget, and now we find out it is not. Let's look quickly at the numbers, the Q4 fiscal year 2023 numbers. Consolidated revenue down 28% to $677 million. Net loss was $20.4 million compared to net income of $242.9 million in the prior year quarter. Adjusted EBITDA, $47.9 million. That's a margin of 7.1% compared to $334.4 million, or a margin of 35.5% in the prior year quarter. So a massive shrinking there. Cash flow from operations dropped 78.5%. Shipments, however, were actually up in the quarter, 571,000 tons compared to about 547,000 tons in the prior year quarter. Now, the weaker year numbers were largely driven by lower steel prices. Revenue per ton of steel sold was $1,185 compared to $1,721 in Q4 of fiscal year 2022. And if you look at the cost overruns we talked about in that EAF project, Algoma's project will feature a pair of electric arc furnaces that will replace the plant's existing blast furnace, coke oven, batteries, and basic oxygen steel making operations. They will be far more efficient and should lead to better cash flows over the long term. Now, management surprisingly increased the budget for this project by $125 to $175 million. That would be total project cost of between $825 to $875 million. That is up from what they estimated just in January at about $703 million. So that represents 59 to 83% increase over the remaining capital yet to be contracted last quarter. It appears that the detailed engineering work for the project was completed about 6 weeks ago, and Algoma received bids that carried higher than anticipated costs. Additionally, supply chain disruptions, particularly related to microprocessing chips, are expected to delay the commissioning of the project until the end of calendar 2024 compared to the initial timeline, which was about mid-calendar year 2024. So current valuations very quickly. On a trailing basis, Algoma looks attractive. PE is 5.4. EV to EBITDA is 1.9. However, estimates for fiscal year 2025, so 2 years out, earnings and EBITDA are significantly lower right now. Those are the estimates from analysts out there. I'd call them guesstimates at this point, but they're for significantly lower results. The balance sheet quickly: cash $247.4 million, debt $122.7 million, so net cash of $124.7 million. Our take here: the electric arc furnace project appears to be a smart one, but the cost overruns and the launch delays are unfortunate near to midterm for the company. While management stated that internal cash generation and an anticipated working cap release of around $100 to $150 million should be more than sufficient to fund Algoma's capital requirements, even with those cost overruns, we do note, though, that the company just filed a base shelf prospectus allowing them to raise additional capital. So the issuance of shares at depressed prices is a potential threat to keep an eye on for existing shareholders over the next year. Algoma, as with all commodity sensitive businesses, is highly sensitive to the pricing of its underlying commodity, in this case, steel, for its profitability. The balance sheet is currently solid, which is a must. It's solid, which is a must for investing in a business such as this. But it could move into a net debt position funding that project, dependent upon the pricing environment for steel. If one believes that steel is headed higher over the next 3 to 5 years, as the more efficient operations are brought online, Algoma is interesting, but projecting the price of steel or most commodities is often tantamount to guesswork. As a result, it remains speculative as an investment, and given the near-term cost overruns, uncertainty in the economic outlook generally, we are not buying Algoma at present.
Yeah, and you make a good point. I mean, really looking at a trailing P multiple on a cyclical commodity sensitive stock is irrelevant. And this goes for oil and gas, goes for mining.
Yeah.
You're always with any stock looking forward, of course, but with some companies, there is some certainty in the revenue and the earnings that they're going to be able to produce over the upcoming year, or some stability in the financial performance. Whereas in a commodity sensitive stock, there's nearly none. So what I always look for, I mean, if I am going to do research on a commodity sensitive stock, one, the balance sheet, I want to see minimal debt, because you just don't know what kind of position the company is going to be in to service that debt if commodity prices go down. Obviously, I want to have some assurance or some belief based on my research that the supply demand fundamentals of that specific commodity are favorable. And then beyond that, I want to see that the company is doing something to take advantage of a situation by, say, expanding capacity, as opposed to just being a commodity price taker where the earnings and the share price are going to go up and down with the underlying commodity. In some cases, you can find other ways to invest in the commodity more directly, as opposed to through a stock.
Yeah, for sure. And then that is one of the pluses with Algoma. They do seem to be modernizing the facility, bringing more capacity online, and particularly it should be more efficient as well. So, I mean, if you saw steel pricing boom again, or you saw a positive environment for them going forward, that would definitely be a plus. They'll be more profitable. But you can see with those numbers that I just ran through for that quarter, how fluctuative they can be. They actually had an increase in output there in the quarter, and the results were down tremendously across the board. And that's just the pricing of steel, really. I mean, they had some other, cost issues in the quarter as well, but primarily it's the price of steel. And, that can translate to any commodity based business. And that's why it's very difficult to forecast cash flows for these businesses. And you're better, if you're it's hard to invest in them over the long term. It's more of a trade. So, Aaron was correct. If you're going to look at these, make sure you have a business that has a good, solid balance sheet. Often net cash is best. And then, some impetus for growth, but then all of that can be said and the commodity price can go against you, and you're going to do poorly that year, likely in that investment. But, if you have those things, at least you will survive for the next upcycle. That's what we're looking for if somebody is looking to invest in these type of investments.
Pretty crazy that they 59% overrun in costs is what you said.
On that, in the additional capital, and that'll be at minimum. It could be above that, but that's the additional added capital. It went from about 703 to up to I think it's 800 and something, right? So yeah, it's about 150 off the 703 million in terms of cost overruns, but on the additional capital, right, that's still left out there, it is 53 to almost 80% overrun. So, it is quite surprising that it's that much more, particularly when they were on time, on budget, and boasting that kind of at the start of January or the end of January. So not a significant time period, and not a period where we've actually seen commodities go significantly higher. Over that period, they were already at that level. So there should have been, you would think, potentially some idea that there could have been a cost increases, particularly of that magnitude in January of this year. And as I understand, they weren't stated at that time. So, and they kind of just came out this past week.
Yeah, like I also, just to go on a little bit longer on it, I wrote a report for clients, a monitor report on the company back in January. And as well, when steel prices were really, really high, they ended up buying back a substantial amount of shares. I believe it was about 28% of all of their issued and outstanding shares. So, I mean, it was nice that
I
they're at
think
least
it was
returning capital.
significantly higher than they're priced right now, right?
Yes, I believe so, at $9.75 US per share.
So, yeah, US. So we're talking
US.
$9 Canadian right now, right? Nine
Yeah,
something in that range. So, yeah, I mean that's the thing. It's share buyback, but if you just bought
maybe
in the
not
market today, you'd be buying at a significant discount to that price. So,
yeah,
was it a good use of funds?
it's
I
a good
mean,
point.
we'll find
Yeah,
out over the long term.
yeah.
Depending on how well that project comes on and how efficient they are. So,
Mhm.
company to look at. Certainly not the worst like steel producer that you can see. There's certainly more debt heavy businesses out there that we wouldn't touch, but again, you're just going to be beholden to the price of the commodity to a large degree. Now,